US on high alert. After Japan's historic debt crisis erupts. What if the next global financial shock doesn't start on Wall Street, but quietly inside Japan's bond market? What if the safest assumptions in your portfolio are already breaking, and the warning signs are flashing right now? A nation buried under decades of debt, a bond market behaving in ways it never has before. And, suddenly, the United States is forced onto high alert. Currencies are shifting, capital is moving, and decisions made thousands of miles away may determine the future of American markets. This is not a prediction. This is not a theory. It's already unfolding. And what happens next could redefine global finance for years to come. Welcome to Boring Currency Index. Now, if you're someone who's seen a few market cycles, maybe you remember when money felt simpler, I'd kindly ask you to subscribe, not for excitement, but for clarity, and tell us in the comments, where are you watching from today? The warning did not arrive with a dramatic announcement. It appeared quietly inside a market most people never watch. In Japan, long-term government bond yields began moving in a way they were never supposed to move. For decades, these bonds had been controlled, stabilized, and held in place by policy. That control is now weakened. Japan carries the highest debt burden of any major economy in the world. Its debt is more than twice the size of its entire annual economic output. For many years, this did not cause panic because interest rates stayed close to zero. Borrowing felt painless. Governments could spend without immediate consequences. Investors learned to believe the system was permanent. That belief is now being tested. When yields on Japan's longest-dated bonds climbed to levels not seen since those bonds were created, financial institutions took notice. These were not normal fluctuations. Bond markets are typically slow and calm. When they move sharply, it signals stress beneath the surface. In Japan's case, the move suggested that investors were demanding higher compensation to hold government debt. That shift alone changes everything. The situation quickly drew attention beyond Japan's borders. The United States responded with concern, not because of politics, but because of financial exposure. Japan is one of the largest holders of U.S. government debt. Its investment decisions affect American interest rates, currency stability, and capital markets. A disturbance in Japan's bond market does not stay local, it travels. For the first time in years, policymakers in the United States began treating Japan's debt problem as an immediate risk rather than a distant issue. Currency markets reflected that concern. Volatility increased. Investors started reassessing assumptions that had guided portfolios for decades. What was once considered a stable foundation began to look fragile. This moment matters because it marks a shift from theory to reality. For years, analysts warned that Japan's debt model depended on permanently low interest rates. Now those rates are rising. Once that process begins, it is difficult to reverse without consequences. Higher yields increase borrowing costs. Higher borrowing costs strain government budgets. Strain invites further market pressure. The alarm, therefore, is not about a single number or headline. It is about confidence. Bond markets operate on trust. When that trust weakens, capital looks for safety elsewhere. In a global system, safety is relative, not guaranteed. The crisis did not start suddenly, but it has now reached a visible stage. What comes next will depend on how deeply this instability spreads, and how prepared investors and institutions truly are. Ever wondered how Japan, a global economic powerhouse, ended up with a national debt over twice the size of its entire economy? Let's break it down. It all started back in the 1990s, when Japan's economic bubble burst. To stimulate growth, the government started spending big, and the Bank of Japan kept interest rates near zero. This created a cycle. The government borrowed, and the central bank bought the debt. For decades, this seemed to work, but it turned into a massive balancing act. Now, with a shrinking and aging population, there are fewer workers to support the economy and more retirees needing Social Security. This puts immense pressure on government spending. The Bank of Japan is stuck between a rock and a hard place. If they raise interest rates to control debt, it could crush the economy. If they don't, the debt pile just keeps growing. It's a decades-long economic experiment, and the world is watching to see what happens next. Thanks for watching. Don't forget to like and subscribe. When the Bank of Japan let interest rates rise, even a tiny bit, the impact was instant. Bond prices dropped and yields shot up. Investors who once trusted the system started to wonder if control could really last. See, markets don't need certainty to panic. Just a little bit of doubt is enough. Then came the political pressure. Japan's leaders kept signaling more spending, even with debt costs climbing. To investors, this looked like denial, not discipline. And bond markets hate denial. They want proof, not empty promises. What's unique about Japan isn't just the massive debt. It's how long the system depended on this artificial stability. The longer you suppress risk, the bigger the explosion when it finally blows. Decades of risk don't just vanish. That's why Japan's debt machine is now sputtering. It was built for a world that no longer exists. Stay tuned for part 2, where we dive into why this crisis is structural and what it means for the global economy. The danger for the United States does not come from Japan's debt alone. It comes from how deeply Japan is woven into the global financial system. For decades, Japanese institutions have played a quiet but critical role in funding American markets. That role is now changing. Japan is one of the largest foreign holders of U.S. government bonds. Its investors purchased these assets not out of loyalty, but out of logic. Borrowing costs at home were close to zero. U.S. bonds offered higher returns with the appearance of safety. The difference created a steady flow of capital into the United States. The strategy became known as the carry trade. It worked only because Japanese interest rates stayed extremely low. As long as that condition held, money moved smoothly across borders. Once rates in Japan began to rise, the logic reversed. When yields at home increase, Japanese investors no longer need to take foreign risk. Holding domestic bonds suddenly makes sense again. To do that, they must sell foreign assets. That process pulls money out of U.S. treasuries and back into Japan. Even gradual selling can push American yields higher. Rising yields affect far more than government bonds. They raise borrowing costs across the economy. Mortgages become more expensive. Business loans tighten. Stock valuations come under pressure because future earnings are discounted at higher rates. What begins as a bond issue quickly becomes a market-wide adjustment. The impact does not stop with traditional investors. Hedge funds and large institutions have used leverage to amplify these trades. When conditions change, leverage works in reverse. Positions must be closed quickly. Assets are sold not by choice, but by necessity. Liquidity dries up when it is needed most. This creates a feedback loop. Selling pushes, yields higher. Higher yields trigger more selling. Markets that rely on constant liquidity struggle to absorb the pressure. Volatility increases and confidence weakens. Currency markets reflect this stress. As Japanese investors repatriate capital, demand for the yen rises. A stronger yen places additional strain on global trade and dollar stability. Policymakers cannot ignore these moves because currencies transmit financial stress faster than bonds. For the United States, this means the problem is no longer external. Japan's debt instability is directly linked to American financial conditions. Decisions made in Tokyo now influence interest rates in New York and borrowing costs across the U.S. economy. Part 3 makes the connection clear. Global markets are not isolated. When one pillar shifts, others adjust. The shock does not travel slowly. It moves through capital flows, leverage, and confidence. And once it reaches American markets, the consequences become difficult to contain. Most investors are taught that risk can be managed through balance. Stocks provide growth, bonds provide safety. When one falls, the other is expected to rise. This principle has guided portfolios for decades. The current environment challenges that assumption. When government debt itself becomes the source of instability, bonds lose their protective role. Instead of acting as a shelter, they begin to behave like a risk asset. Prices fall as yields rise. At the same time, equities struggle because higher rates reduce liquidity and future earnings value. Both sides of the portfolio weaken together. This breakdown is not theoretical. It occurs when markets question a government's ability or willingness to control its debt path. Once confidence fades, investors no longer treat bonds as a safe anchor. They treat them as exposure. That shift changes how capital moves and how losses spread. For pension funds and long-term savers, this creates a serious challenge. Many portfolios are structured around long-duration assets. These assets are highly sensitive to interest rates. Even small increases can lead to large valuation declines. Rebalancing becomes difficult when all traditional options move in the same direction. Currency risk adds another layer of complexity. If capital begins to move across borders in response to debt stress, exchange rates become unstable. A weakening dollar can raise import costs and inflation pressure. A strengthening dollar can strain global liquidity. Either outcome introduces uncertainty that businesses must plan around. Decision makers must also consider liquidity. In periods of stress, assets that appear liquid can suddenly become hard to sell without discounts. Forced selling often occurs at the worst possible time. This is when risk management matters most, yet becomes hardest to execute. The key insight of this phase is that the environment has changed. Strategies designed for stability may not perform as expected during transition. This does not mean panic is required. It means assumptions must be reviewed carefully. Monitoring becomes essential. Interest rates, currency movements, and bond market behavior offer early signals. Ignoring them invites surprise. Understanding them allows preparation. Part 4 concludes with a warning, not a prediction. When systems shift, discipline matters more than optimism. Investors and businesses who adapt their frameworks early preserve flexibility. Those who rely on old rules risk learning too late that the foundations have moved.